Look, I get it. These stock images of shiny crypto coins and generic charts look like they were pulled from a 2017 meme page. And yeah, sometimes the footage doesn't quite sync up with what I'm saying because, surprise, we're just a bunch of amateurs piecing this together on a budget. But stick around anyway, because the real juice here is the breakdown on crypto market structure that's actually gonna help you navigate this Wild West without losing your shirt. We're talking basics that cut through the hype. This isn't financial advice, folks, purely educational and for entertainment. Crypto's volatile as hell, so do your own research, talk to a pro if you're serious, and never bet the farm. That's the curiosity gap in market structure sucking you in. It's the invisible framework that turns random price wiggles into predictable patterns, and ignoring it is why most newbies get wrecked. Today, we're unpacking the basics so you can spot the signals before the next pump or dump hits. Let's start with the big picture. What even is crypto market structure? At its core, it's the way prices move, orders flow, and liquidity sloshes around in the digital asset world. Unlike traditional stocks with their tidy exchanges and regulations, crypto markets are a 24/7 global party where anyone with an internet connection can join. Think of it as the skeleton holding up the flashy price action you see on apps like Binance or Coinbase. Why does it matter? Because understanding structure helps you read the market's mood, bullish when buyers dominate, bearish when sellers crash the vibe, and avoid knee-jerk trades that feel smart in the moment but leave you bag-holding at the bottom. Pulling from the chaos of recent headlines, like the Clarity Act shaking things up or warnings about custody risks, market structure is evolving fast. It's not just about Bitcoin dipping to $100,000 or Solana's network activity tanking. It's the underlying mechanics that dictate if a rally has legs or if it's built on sand. For beginners, grasping this means shifting from FOMO-driven buys to strategic plays. Imagine the market as an order book battlefield. Bids below the price fighting asks above it. High liquidity means smooth trades. Low means slippage that eats your profits. And with tokenization of equities creeping in, traditional finance is blurring lines, making crypto's structure even more crucial to decode. As we zoom into those physical coins gleaming there, Bitcoin, Litecoin, Zcash, they're the stars, but the real action is in how they're traded. Market structure basics boil down to participants, venues, and flows. Participants. You've got retail traders like you and me, institutions dipping toes via ETFs, whales moving mountains with big orders, and miners securing the blockchain. Venues range from centralized exchanges, CEXs like Binance, where most volume happens, to decentralized ones, DEXs on Ethereum or Solana, which are permissionless but can get congested. Now picture that mobile screen flickering with live data. It's your window into the frenzy. Liquidity is king here. It's the ease of buying or selling without nuking the price. In a structured market, deep order books mean tight spreads. In crypto's wilder corners, thin liquidity leads to flash crashes. Take Bitcoin's retreat. Structure shows if it's a healthy pullback or panic sell-off by watching volume spikes. Tools like candlestick charts reveal this. Green candles for up days, red for down, with wicks showing rejection levels. Hand on the whiteboard, sketching it out. Yeah, it's like we're in crypto class 101. Order books are the heartbeat, a list of buy, bid, and sell, ask orders sorted by price. The spread between top bid and ask, that's your entry cost. Imbalances signal direction, more bids stacking, bullish structure brewing. We've seen this in Ethereum's price basics, where steady bids build floors during dips. Fast forward to that dynamic screen analysis, charts pulsing like a heartbeat. Reading market structure means spotting higher highs and higher lows for uptrends, or the opposite for downtrends. It's not rocket science, but it beats guessing. For example, a bullish structure might show price respecting a rising trendline with volume confirming the push. Practical takeaway: use free tools like TradingView to overlay these. Start with daily timeframes to avoid the noise of one-minute scalps that fry your brain. Coins overlaid on graphs, blending the tangible with the abstract, perfect for seeing how structure ties assets to action. Diving deeper into main point 1, the building blocks of crypto market structure. First up, price action patterns. These are the footprints left by buyers and sellers. Support levels, where price bounces up repeatedly like a trampoline for bulls. Resistance, the ceiling sellers enforce until it breaks. That quick Bitcoin display on screen, it's the asset at the center, but structure is what moves it. In crypto, unlike stocks, global time zones mean structure shifts with Asian, European, and US sessions. Asian hours often set the tone with lower volume, while US Open can spark volatility. Key metric: trading volume. High volume on breakouts validates moves. Low volume rallies. often fakeouts. From Grayscale's insights on sectors, DeFi tokens show structure tied to network activity, Solana's 50% drop in activity, weak fundamentals eroding structure leading to breakdowns. Ethereum coin against the graph backdrop. ETH's structure often mirrors BTC but with its own flavor from smart contracts. To read it, learn market profiles. The volume at price levels forming a bell curve of activity. Value areas where most trading happens signal fair price. Extremes show imbalances. Example, if Bitcoin's retreating to $100K on low volume, structure suggests a potential reversal if bids pile in there. Interactive trading footage, fingers flying, mirrors how pros dissect this. Another pillar, order flow. In advanced terms, it's the real-time battle of limit orders. Tools like footprint charts show aggressive buying, market buys hitting asks versus passive. For basics, just know that in a healthy structure, flow aligns with trend. Bullish means more aggressive longs. Smartphone blockchain demo. Mobile trading's huge in crypto, structure visible on the go. Liquidity providers like market makers on exchanges smooth this flow but can manipulate in shady spots. Watch for spoofing. Fake orders pulled last second to fake depth. Regs like the Clarity Act aim to clarify this mess, separating securities from commodities to build fairer structure. Man analyzing intently, that focus is what you need. Risks in structure, gaps from news events like SEC custody warnings. If your exchange holds keys poorly, hacks wipe structure clean. Always use hardware wallets for long-term holds. Bitcoin and alts with charts. Trends across assets show correlated structure, but alts lag BTC. Main point one takeaway, start journaling trades with structure notes. Did price respect support? Was volume there? This builds intuition over time, turning you from gambler to analyst. Close up on BTC and ETH, charts weaving tails. Transitioning smoothly, let's hit main point two. How to read and trade crypto market structure like a pro, even if you're just starting. That spinning Bitcoin hologram, cool effect, but let's ground it in reality. Reading structure starts with candlesticks. Body size shows conviction, shadows indecision. A doji after a rally, structure shifting, potential top. Bullish engulfing, buyers reclaiming control. Gold and silver coins on volume graph, volume's your truth serum. In structure analysis, rising prices on falling volume screams divergence, weak bulls, incoming bears. Practical, on a platform like IG Bank, scan for these in strategies like trend following. Enter longs on pullbacks to support in uptrends with stops below. Sign flashing cryptocurrencies, it's the ecosystem calling. For trading, identify structure breaks. When price slices through key levels on volume, trend changes. Example from Bitcoin's ebb and flow. After hitting $100K, if it holds and forms higher lows, structure turns bullish. 2% pullback often key in crypto's volatile swings. Hand diagramming on whiteboard, back to basics, drawing trend lines connecting lows. Break above, buy signal. False breaks trap shorts, common in crypto's manipulative vibes. Tablet trends analysis, wider view shows multi-timeframe structure. Align daily uptrend with hourly pullback for entries. Sarcastic aside, yeah, it's not as easy as TikTok gurus make it, but nailing this beats YOLOing into memecoins. Stock trading image bridging to crypto, finance worlds converging via tokenization. In Part 1 Basics, equities on blockchain mean hybrid structures, stock-like stability with crypto speed. Read it by watching cross-asset correlations. BTC dumps often drag tokenized assets. Another tablet deep dive, arrows pointing paths. Strategies within structure, breakout trading waits for volume-confirmed escapes from ranges. Range-bound, fade the edges, sell resistance, buy support. From the best 5 strategies, scalping structure uses tight structures on low timeframes, but for beginners, swing trade weekly structures to avoid burnout. Bitcoin theme solidifying concepts. Risk management ties in. Never risk more than 1–2% per trade, using structure for stops. If bullish structure breaks, exit fast. No ego. Mobile trading dynamic structure on your phone means constant vigilance. Watch for news impacts. Clarity Act complexity could tighten CEX structures, reducing wild swings but adding compliance layers. Financial market footage, broader lens. Main point 2 pro tip, backtest on historical charts. Replay Bitcoin's 2025 Q4 sectors, strong fundamentals per Bitwise CEO mean resilient structure despite routes. Practice spotting these and you'll trade with edge. Blockchain photo supporting infrastructure talk. Now main point 3, the risks, regulations, and future of crypto market structure, because knowledge without caution is just expensive optimism. Bitcoin icon stark, assets vulnerable without solid structure. Risks first. Illiquidity in altcoins leads to pumps on thin air, dumps on whales exiting. Solana's rally on weak fundamentals. Structure cracks under activity drops, prices follow. Hands-on laptop charts analyzing to mitigate. Custody risks from SEC, store on exchanges. Hacks like past FTX show structure collapses when trust breaks. Self-custody via wallets preserves your control, but seed phrase security is non-negotiable. Stock market crypto blend, broader context. Manipulations rife. Wash trading inflates volume, faking strong structure. Regs like Clarity Act push for transparency, defining what's a security to clean exchanges. Man with laptops, dual screens, pros hedge risks. Volatility's baked in. Structure helps via diversification. BTC for store of value, ETH for utility. Futures trading adds leverage, but risks amplify. Definitions contracts betting on price, traded on CME or Binance, but margin calls wreck unstructured positions. Bitcoin keywords image trading analysis core. FutureWise 2026 navigation sees more institutional structure via ETFs, stabilizing but slowing moonshots. Tokenization basics. Equities as tokens mean fractional ownership, structure like stocks but on-chain speed. Hand-holding coins, value tangible, risks real. Pros, 24/7 access, borderless. Cons, hacks, regs, uncertainty. Takeaway, layer structure reads with fundamentals, network activity, adoption, looping back to those coins, full circle. We've covered the basics, from order books and liquidity in context to reading patterns and strategies in point 1 and 2, risks and regs in 3. Recap quick. Market structures your map, spot trends via highs lows, confirm with volume, trade aligned, and DYOR on risks like custody. It's empowering, turning chaos into opportunity. What's your biggest structure struggle? Charts confusing you or regs scaring you off? Drop in comments. If this clicked, smash like, sub for more crypto breakdowns, and share with a friend who's still YOLOing blindly. Peace out. Trade smart.